All right, welcome to Financials for Startups. So in this video, we're going to be walking through how to conduct a basic financial feasibility, trying to make a decision on whether or not there is a potential for us to execute on the idea that we have. So the kind of target for this video, if you're kind of wondering if this is for you, is someone who is considering starting a business, maybe has gotten a little bit of market feedback, seems to be kind of supportive of furthering the idea, but we need to evaluate it from a financial standpoint. So if you're kind of in that position, let's say, this is going to be a helpful video for you because at the end of the day, we want to know, does the idea pencil out? If we go through the energy of launching the business and doing all of the different things that are required in order to launch a business, are we going to be profitable? And can we be profitable based upon our current idea? So this is going to be a pretty quantitative type video. So I encourage you to kind of stop and start depending upon where we're at and if you need to kind of go back and review a couple things. But the ultimate goal that we're going to finish with is we're going to make a determination as to the financial feasibility of the idea in a more basic sense. Can we make money? And does it make sense for us to exert the energy into launching this thing? So there's a couple of things that we have to get through first before we can do this type of analysis. So the first thing that we need to be able to figure out is we have to figure out how much money we make by selling one of our products or services. So there's a lot of different terms for this. The one that I typically use is the economics of a unit. And so we're essentially just trying to figure out is if I sell one item, whatever that looks like for you, can we make money? What does it cost us to actually create this product or offer this service? So what are all of the costs that go into it? And then ultimately, what am I pricing at? What's that difference? If we can't make money from selling the actual unit itself, then we're going to have a lot of problems because from a business standpoint, there are a lot of costs that we have to go into. So just to kind of highlight some of those things, when we're operating a business, there's a lot of different expenses that we have. Generally speaking, we put those into two categories. So the first category is what we call a variable cost. Now, a variable cost is exactly what it sounds like. It varies, but it varies specifically based upon our sales. So these are expenses that will increase as we sell more of something. So the way to look at this is if we were to develop a little graph here, and on the bottom axis, this is going to be revenue, and this is going to be our costs. Variable costs kind of go up like this. So they go up in proportion to what our revenue is. And that's because we need to incur these in order for us to be able to sell an actual product. So just as a basic example, I own a coffee roaster. So we import, roast, and then we package and distribute coffee to a wide variety of locations. So for us, let's say if we were to try to figure out how much money we could make on a bag of coffee, and so we'll just pick we'll pick a 12-ounce bag of coffee. We would need to know what are the variable costs, what are the costs associated with selling that one unit. And so for us, you could say, obviously, our variable costs include coffee beans, because it's really hard to sell a bag of coffee without the beans itself. I mean, I've tried to do it. It doesn't really work out that well. And we need an actual bag to put the coffee in. If we need a label, if it's not already on the bag, we need an actual label itself. And then we need some labor, right? We need someone who is going to roast the coffee. We need someone who is going to fill the coffee into the bag and then seal it and then package it and get it ready for shipment. So all of these things would be considered our variable cost because I cannot get around incurring these expenses if I ultimately want to sell a bag of coffee. And that's where this line here kind of comes into play, is because the costs are going to go up as my revenue increases as well. Now, in terms of the variable cost, there's a couple of different types, right? So under variable cost, I'm going to write variable cost here. there's a couple of different types that you'll want to consider. And every business, it looks a little bit different. I'll kind of explain kind of how that looks. So the starting points, or the first ones I should say, are ones we kind of talked about, and that's what we call direct materials. So the direct materials are the physical goods that go into producing your product or offering your service. So physical goods here would include the coffee beans, the bag, and the label, right? Those are all physical items that we have to put together, and they're component goods, and we have to use those in order to create a finished product. The next type of variable cost is what we call direct labor. Now, our direct labor is the time that it takes for us to pay someone, or the rate of pay that they receive from having to do something. So in this case, we're having them create one bag of coffee. So we want to know the time associated with creating that bag of coffee and all of the processes that go into place and are associated with that. So we're looking specifically at the time that it would take to create that and going through that process, right? From roasting the coffee to packaging it and ultimately getting ready for distribution. Now, on top of this, we also have what we call other variable costs. And this is a very broad category, but ultimately other variable costs include costs that are associated with the sale, but ultimately don't fall into these two categories here. So a couple of examples include credit card processing fees, which we often forget about. Include shipping expenses, which can, especially for my business, can be pretty sizable depending upon what you're sending and to what location. Could include sales commissions, if we're paying somebody else a fee to be able to sell our products, and a couple of other things. And so these are things that we obviously want to include as well. So when figuring out our variable costs, we're going to add all of these things up, and we're going to figure out how much it would cost us to actually produce an actual product. So let's kind of go through some calculations just so you can see how this would work. So let's say, I'm going to make a list here, and let's get a little bit more room. And I'm going to say we've got coffee beans, and we've got a bag, and we've got a label. So we have to figure out what our expenses are. Now, since I obviously run this business, I'm more familiar with the cost, so I'll kind of just make those up. But for your business, you're going to want to think about all of the different costs that you have, and you're going to want to get prices for those. I would not encourage you to do like just a basic search online and go with anything you find, because what you'll find is a lot of those expenses, one, might not apply to you, so they're purchasing things in bulk and you might not have the capital to do that up front. The other thing is you might not want to meet the minimum order quantities that many of those expenses are associated with. So you might have to purchase 10,000 units, and you might say, well, I don't have the financial flexibility to do that. So the best way to do it is either to talk to somebody who operates a similar business and they understand what the costs are, or to pick up a phone and actually call suppliers and get a quote. And that's the best way to do this, because you're going off of actual data versus what you think it's going to cost you. And oftentimes we undershoot those expenses. So for coffee beans and the bag and the label, let's say that for 12 ounces, our coffee beans costs us $3 per pound. And the bag itself is 50 cents. And the label itself is 10 cents. And then we also have labor. So what I'm going to do first, though, is I'm just going to add all these up here, because these are our direct material expenses, right? So this is going to be our direct materials per unit. So here we've got $3.60. That's how much we have in direct materials. Now we need to figure out our other variable costs, right? Or not our direct labor, I'm sorry. So our direct labor, in order to figure this out, you would actually have to try and time how long it takes, right? So we're ultimately figuring out time multiplied by wages is ultimately what your direct labor is going to be. So we're not going to go through that process, because if you understand kind of basic arithmetic, you can get that no problem. So we're going to say that the labor itself adds an extra $1 to the actual price. So that's our direct labor per unit is $1. Well, now we have to figure out our other variable costs, right? The OVC, as we commonly refer to them as. So there's a couple of things here. For my business specifically, we sell things through multiple channels. And so sometimes we incur credit card processing fees, sometimes we don't. But we price assuming that those credit card transaction fees are there, because I'd rather build those into the price of my product versus later on trying to do so, and then you're raising prices on customers, which historically they do not like that. The other thing that's important is because you're pricing yourself largely based on these figures, and if we don't accrue them and incorporate them into our pricing, then oftentimes what can happen is we're not making as much money as we think we are. So it's important to include those. Now, a credit card processing fee varies, but the simplest one, at least for, I'll put CC for credit cards, that I've seen is 2.9% of the transaction plus a 30-cent transaction fee. Now, if you're selling something that's not very expensive, that's a pretty big percentage, right? If you're selling something that's several $100s, then it's not going to be as big of a portion of your revenue base. But if you're selling something that's not very expensive, you can't really absorb this 30-cent transaction fee as much. So just as an example, let's say that we're going to sell coffee at $15. So we've got a $15 bag of coffee, and we're going to pay 2.9% in the processing fee, which is going to be 43 cents, plus that 30-cent transaction fee. That means that roughly 74 cents is going to go just towards the credit card processing fees. So at a $15 item, that's a pretty significant percentage of the overall value of the product, right? Which is why we certainly want to calculate those as well. So let's add all these three up. Now, for your business, you're going to want to make sure and again, go through all the direct labor, think about your other variable costs and all of your direct materials. So I'm going to move down here and I'm going to list all these. So we've got direct materials per unit, which means per bag sold in this case, of $3.60. We've got our direct labor per unit of $1. And then we've got our other variable costs per unit of 74 cents. Now, in reality, for this other variable costs, we of course incur shipping expenses when many times that we ship, especially over a certain value. So that's something that we would incur. But for this example, I'm not going to include those just for simplicity's sake. So the result of this is going to be our total cost of goods sold per unit, which I'm going to abbreviate as COGS, or COGS is the common terminology. So if we bring back our calculator here and we clear this, and we've got $3.60 plus $1 plus 74 cents, that's $5.34 that we have in costs. So there we go. We've got the first part done. We now know exactly how much it's going to cost us to produce an item. We've covered all of the variables involved. And so we should feel pretty good about ourselves because we have a good understanding of what it's going to cost us to make. So the next thing we need to do is we've got to go through and figure out what we call a contribution margin is. Now, a contribution margin, I'm going to change pen colors here. So our contribution margin is the amount of money that contributes to covering our fixed costs. And I will explain what fixed costs represent, so don't worry about that. If that's a little unclear right now, we will go into that. So the first thing is we're going to figure out how do we calculate our contribution margin. So I'm going to move up so I have a little bit more room here. And let's choose a different color. I'm getting kind of tired of the white. And so we're going to have our price per unit. Whoops. And since we calculated our credit card processing fees off of $15 per unit, I'm going to say that our price is $15 even. And then we are going to deduct our cost of goods sold per unit, And that, of course, is going to be the $5.34. And the difference, this is what's going to be our contribution margin per unit, or I'm going to abbreviate simply as CM per unit. So that we could use a calculator. Fortunately, I can do somewhat basic math, and we've got $9.66. So this is our contribution margin per unit. So every item that we sell, we make $9.66. So assuming that we've calculated the totality of all of our variable expenses, you could simply take this number and you can multiply it by the number of units sold. And this will tell you what your gross margin is, how much money we actually made. Now, another terminology, if you have an accounting background, this contribution margin per unit is often referred to as our gross profit. So just to explain the terminology, I use the terms contribution margin per unit because from a startup sense, it's really helpful for us to make the connection that this money is what's available to cover what comes next, and that's going to be our fixed expenses. So what I would encourage you to do at this point is stop the video and do some research on your own and try to get up to this point to where you have a contribution margin or gross profit per unit figure, which for us is this $9.66, and do the calculations on your own. Again, I would encourage you to try to get as realistic numbers as possible. So that if that involves picking up the phone and calling potential suppliers, contacting other people that run businesses that operate in a similar space, oftentimes you'll find these individuals to be very forthcoming with information. So having a conversation with someone is a great way to get information. As a third kind of option, if you absolutely, for whatever reason, can't do the first two, you can look online, but again, just the word of caution is a lot of times those figures are not entirely accurate. And the last thing that you want to do is make a decision as to whether to move forward with an idea based upon inaccurate data. So that's what I'll say there. So now that we've got this figure, we're going to figure out what we call our fixed costs. So I'm going to change pen colors again here. And we're going to talk about fixed costs. Now, the way that fixed costs work, and again, we have the two categories, right? We've got variable and then we've got fixed. So fixed costs actually remain the same. So they are not tied to production. So that example that I gave you moments ago where we had the chart and on the bottom axis we had revenue and on this axis we had costs. The way that fixed costs kind of work is they sort of go like this. They stay flat and they temporarily increase. Oops, that looks really bad. Let's try this again. So they stay flat, they temporarily increase, and they stay flat for another period of time. So notice they're not directly tied to our production, much like they are variable costs, where variable costs kind of just go sort of like this. So fixed costs are different. And the reason for that is that a fixed cost primarily are things that we would term to be like overhead. So a great way for remembering fixed costs is by the acronym USAIIRD. This represents fixed costs. And so we have utilities, we have salaries, we have advertising, which encompasses really all marketing type expenses. We have insurance, we have interest, and we have rent, and then we have depreciation. So I'm going to speak to each of these, but I at least want to make sure that you have them available so you can start figuring out what your fixed expenses are. Now, similar to your variable costs, the way that you want to get fixed costs is, again, by trying to get actual data. So we're going to go through these and then we'll kind of talk through some ways to get some of the different data sets. But as you see them, they're all pretty standard for the most part as far as what information is included. So for utilities, utilities is one of those categories that refers to quite a bit, in fact. So utilities can include everything from your phone and internet, which is usually a pretty big priority, to your electricity or gas as well. If you have a physical location, you're going to pay the city for like trash removal and different services and even water. And a host of other things. So sitting down and thinking through all the utility expenses is really, really important. Now, just if I can go back and kind of relate this to the fixed costs, the reason we call them fixed is because as your sales increase, these typically stay the same, right? So if your sales double, your utility bill doesn't double as well, right? That's pretty good that it doesn't, in fact. So instead, it goes up within a relevant range, right? Once you grow to a certain extent, you kind of get to a period to where you've outgrown your existing bandwidth speed. Let's say you've hired like 20 more people and you realize that your wireless internet is not going to accommodate that many users. So you would temporarily increase your expenses one time, and then you would operate for another period of time before you actually had to increase your expenses. We also have salaries here, and so this is going to represent really those salaries that aren't tied to production. So remember earlier, direct labor would be a variable cost. So this is pretty common with owners or managers who aren't a part of the production process. If you're going to pay yourself a salary, this is where it would come from. Although you might not pay yourself a salary initially, it's really important that when you're doing the break even, that you add in a salary here, because chances are you're not going to want to take a vow of poverty for too long, right? You want to make money, right? That's why you're starting the business. You want to draw a salary, you want to be independent, and you want to give yourself a financial incentive to continue to invest your time. So make sure for the financial purposes that you're including a salary so you have an accurate representation of how much money you'll have to make in order to cover all these expenses. Next, advertising expenses. So this goes without saying. When you open up your doors, people aren't automatically going to flock to your business. When you start your online website, people aren't automatically going to come to your website. You have to have a mechanism for drawing them in, whatever that looks like. And a lot of times those mechanisms cost money. So make sure that you're allocating a fair amount of resources to advertising so that you can get traffic or visits or shoppers to make sure that you can obviously do business. Next thing, insurance, really important. From the most basic sense, you're probably going to want to get a general liability policy, but depending upon the type of business you operate, you might need other types of insurances. So you really want to do a lot of research here to figure out the types of insurances that you should be carrying to make sure that you're adequately covered in the event of some kind of issue, whatever that may be. Again, kind of similar to the other examples I gave, it's always good to pick up the phone, contact an agent, and get a quote based upon your situation. Or if somebody is operating a business that's in a fairly similar space, they might be willing to provide you with the information, what they pay for their insurance that you can use as kind of a baseline. Now, interest here, I'm going to put an asterisk because we're only going to pay interest if we have any debt. So if you start your business with debt, your interest you're going to have to pay regardless of anything, plus the principal payment. So you'll want to include that. And then we have rent here. Of course, if you're going to be operating out of your home, you probably don't need to include rent. But if that's a temporary situation, you might want to allocate some money here so that you're doing a fair amount of so that the analysis is accurate, right? At a certain point, you're going to outgrow your house and your garage and those types of things. So figuring out what rent and what the cost is would be pretty helpful. I recommend in this area looking at LoopNet, which is a commercial website that you can use to find different properties. And it can be very, very helpful for figuring out square footage and pricing, and you can use that as sort of a gauge. This depreciation figure, I'm going to say don't really worry about, at least at the beginning. Depreciation is an accounting expense. So if you purchase equipment, we have to depreciate it over a period of time because it has a limited useful life. And it's not an actual cash flow expense though. So you're not specifically paying any money out, but on your income statement, depreciation will reduce your taxable income, let's say, and your profitability. But I wouldn't really worry about it. And chances are you might not have a lot of equipment at the beginning anyway. So that's something that we don't really need to worry about, at least at this stage. So now that we have an idea about all the different types of expenses, let's just, for the sake of calculations, let's go ahead and we'll add some different things in here and we can do some calculations. And so let's say that after all of our research, we've gone ahead and we've figured out how much each of these things is going to cost us. And I'm going to eliminate interest because I'm going to say we're going to start our business without any debt, which is always preferred if you can do that. So our utility expenses, we've estimated that those, and I'm going to do this on a monthly basis because we want to know if we can cover our expenses month to month and that sort of thing. So utilities, we're going to say that we were going to spend $500 per month. And let's say you want to pay yourself a salary and we want to pay ourselves a $3,000 a month salary, which is fairly modest, so that's not terrible. And we're going to have advertising expenses. We're going to advertise $500 a month. We've added up all of our insurances, and our insurances are going to cost us, let's say, $500 a month. And our rent is going to be $1,200. So then we're going to go through and we're going to tally all of these up. So we're going to say 500 plus our 3,000 plus $500 for advertising plus $500 for insurance and plus $1,200 for rent, and that's going to cost us $5,700 total, or $5,700 is going to be our total fixed expenses. All right, so at this point, we've got two pieces of information. We have to figure out what to do with them. What we're going to do next is we're going to perform what we call a break-even analysis. Now, this is a very simple analysis once you have the data that we can use to help us make a decision as to whether this business has a strong chance of actually being successful. So the way that we're going to do this is we actually will, get some more room here, is our break-even represents our total fixed expenses divided by our contribution margin per unit. So what this represents is this is the amount of units, right? The number of products that we have to sell to cover all of our fixed expenses. So our total fixed expenses, we know, are $5,700. Now our contribution margin per unit, I'm gonna have to scroll up here because I don't remember. That's $9.66. So let's go ahead and say 5,700 divided by $9.66 is 590 units, give or take. So what this means is that for me to operate this business, assuming several things. One, assuming that all of these variable costs are accurate, assuming that these fixed expenses are accurate, I have to sell 590 bags of coffee every single month just to break even. Now that's an important term because breaking even doesn't imply profitability. This does not mean I'm making money. This means I'm covering these expenses. I'm not yet profitable. So the analysis comes in is now we get to make a decision as to, well, is that a realistic figure, right? If we were doing projections and we thought, man, if I sold 50 units a month, that would be awesome, right? That would be a home run. Well, looking at this, we'd have to sell more than 10 times the amount of products. So this might not be a very good business model for us, right? We might have to look at, one, our fixed expenses. Maybe we need to cut some things, right? The biggest thing being salary. But for your business, your biggest fixed expense might be something completely different. Or we might have to revisit our variable expenses. Maybe we can find a cheaper supplier for coffee beans. Maybe we can find cheaper bags. Maybe we can reduce labor costs through some kind of automation. Maybe we can increase the price, but we have to take into account, will customers, or are they willing to pay the additional price? Will they accept that? Is our product of enough quality that we can charge more for it, and what are competitors charging? So these are all different types of analysis that we can do based upon this figure. Now in this example, I did one product. You might have several products, but I would encourage you to pick kind of your flagship product, whatever that looks like, and try to do as thorough of a job as you can by calculating all of your fixed expenses and doing research and getting actual verifiable data, doing the same thing for your variable expenses, and trying to figure out what's your break-even point, and seeing if that's a realistic number. And if it is, fantastic. That means you can continue to move forward. The financial aspect of it is looking promising. But if it doesn't match your expectations, then it might be time to go back and rethink the business model a little bit, and maybe rethink the different products that we're offering, rethink our fixed expenses, look for opportunities we might have to be able to trim some of those if it makes sense. But at the very least, it's a starting point for that analysis, and it's only going to help us moving forward.